The National Investor's motto is, you can get information anywhere, but here you get knowledge. And for well over 40 years now, Chris Temple has imparted that knowledge, an unparalleled, understandable, and useful take on the big picture of the markets and of our world. He has been out in front of what you see on the news every day on many themes. More, Chris has taken this macro knowledge and his unique analytical abilities to uncover unique investment opportunities. Often, he has guided his members to big winners in resources, biotech stocks, and more. His talents and connections often getting him into ground floor opportunities before they are discovered. Without further ado, here is Chris with today's topic.
Welcome back, folks. Today I'm going to be joined in just a minute by my old friend Desmond O'Kell. He is the president of Alberta, Canada-based Enterprise Group. As you see here on the screen, their symbol is simply E on the Toronto Venture Exchange, and here in the US on the OTCQB, the listing is ETOLF. Also on the same slide here, of course, you see their website, their contact email, etc. If you want to contact them for more information, do your own homework and so forth, which I encourage you to do. Enterprise in the last few years, since the times started to get better, especially for the Canadian energy patch, has been on a heck of a tear. As you see here, they gave a fair bit of their stock rebound back for a little while in 2025, but now they've been recovering just as quick. Their earnings, bottom line earnings for 2024 came in a little bit less than expected. That accounted for the drop after that news came out in late March, but they've since regained some ground. And I think, to be fair, the other reason why the company weakened after its share price had gone up more than, I think, 15-fold if you go back to the bottom. I mean, just crazy. So I guess there was some profit taking, but also keep in mind that until recently, when we had the start of a new war between Israel and Iran, energy stocks generally had been weak because of tariff fears and economic fears and stuff like that. But even at its current level, Enterprise is barely selling for above its book value. It's a very tight structure as far as its shares. Management owns nearly 30% of the shares. And it's just been a great story in the Canadian oil patch and energy patch. And Enterprise, of course, as you're going to learn more or relearn as the case may be, is a service company to the Canadian energy industry. Now, before I bring Des on, as usual, I want you to be aware that either he or myself could be making forward-looking statements, as those are defined, talking about the future and plans and things like that. Things don't always go as and when you want them to, so be mindful of that. And also, recently, again, Enterprise, though they've long been a recommended company of mine and a national investor based on their merits, so they don't pay for me to recommend them. They do from time to time, as some of our other companies do, pay National Investor Publishing to do some add-on media work and copywriting and things like that, of which this video is a part. Couple other things before I bring on Des. First of all, pretty much concurrent with me putting out this information and this updated look at Enterprise with him today, I had Des on just a few days ago, and we're pretty much releasing these videos concurrently, where he discusses the broad landscape of what's going on policy-wise and in the industry in Canada, a lot of the political issues surrounding the energy industry. Hopeful that Mark Carney is going to be a better prime minister for the sector than Justin Trudeau was. That said, Canada is imminently, and maybe even by the time you read this or watch this rather, we're going to learn this. They're about to send the first shipment of compressed liquefied natural gas to Asia as a part of the first shipment of LNG Canada, a tens of billions of dollar project, many years in the making, that has now got Canada on the map as an energy exporter. LNG Canada out of the gates is going to be exporting something like 10% of the entire country's natural gas production. Of course, that's all packed up pretty much in the western part of the country that Enterprise services. There's a few other development stage LNG export projects and pipeline projects, which as they come on are going to add to that number. So there's a lot of political moving parts, there's a lot of development moving parts, but suffice it to say, and I'll be talking about this in a near term as well separately, in a couple of different, one video and one printed version of an energy sector special issue. There's a lot of things going on that really underscore the fact that even though we were being told not that many years ago, especially here in the US, that the fossil fuel industry is going to be put out of business, it's bigger than ever, especially the natural gas component, where as far ahead as you want to look, we're going to see natural gas production and consumption worldwide. The demand is just insatiable and it's going to keep growing. And that's going to be good for enterprise, of course, because they service these companies. They were part of the food chain in building the LNG Canada pipeline system. And that's just one of many, many things they're doing. A couple of unique, almost monopolistic businesses, frankly, that they have in Canada, having been a survivor of the long energy bear market up there. Now they're lean and mean and on the acquisition front again, as you're going to learn. And a great, great story. Frankly, as good a story now for investors and as solid as when the share price hadn't nearly recovered to this level. It's still very, very compelling long term if you are bullish on energy and especially the Canadian energy space, as I am. So again, that other work coming up, if you're not on my list, make sure that you get on it as well. And you'll be seeing that as we start to get into the summer. All right, those preliminaries out of the way. Here is my old friend Des O'Kell, the president of Enterprise Group. Thanks for joining me again, twice in rapid succession this time.
Yeah, you bet. No, thanks for having me. Always a good discussion with you, Chris.
Well, and we're going to continue what we did the other day. And as I said before you came on, we're airing this more specific updated profile of enterprise itself, concurrent with the broader energy sector and Canadian policy, et cetera, video that we did the other day. So, folks, you should be watching both of these along the way here as you can. But before we get into a couple of the more recent major acquisitions and additions to the company that you guys made, let's just give people a quick Cliff Notes recap of Enterprise's, pedigree as being essentially a service company to Canadian energy and infrastructure companies.
Yeah, well, thanks for the intro there. Yeah, Enterprise, I mean, this is nice to note that we're entering our 21st year in business now. So, you and I have talked over many years, many of those 20 years, but, it's definitely we've been around for a while. We've had some iterations through the different cycles. But generally speaking, right now, our clients are the producers. So we are bringing out site infrastructure to their project sites. Now, quite often people say, well, what is site infrastructure? Well, these project sites are anything from drilling, completions, when they're building their plants and their gathering systems out in the remote areas. They require some infrastructure on those sites to operate. These sites are in remote areas, so they're away from any power infrastructure like overhead lines or what have you. So it is an opportunity where they, of course, these are 24/7 operating. Nobody shuts down at 5 o'clock in the evening, comes back at 7:30. These are 24/7 operations from the start of the project to the end of the project. So they need mobile structures, offices, command centers, medic buildings, even bathrooms and so forth. So we have a fleet of mobile structures. Obviously, as I mentioned, they're away from any kind of power infrastructure, so they need mobile power. And of course, what is important, especially when we're working in Northern Canada for half the calendar, we have a tremendous amount of darkness in winter. So lighting is on all the time. 24/7 lighting is on, whether it's January or June, lighting is a big deal. So those are the three kind of pillars of what site infrastructure is. Now, there's many other items and ancillary infrastructure equipment that we have that fills in many needs and so forth. But that is essentially what site infrastructure is, and the client needs those items in these remote areas. So very important that everything is mobile, everything is robust. I mean, even this last winter, second week in February, we're up in a particular region of northeastern BC. We achieved, or the conditions achieved, a minus 52 degrees C 2 nights in a row. So, I mean, stuff has to be able to operate in the most extremes, and of course, that's what we build our equipment or we build our fleet around. Very, very robust things that can handle these minus 40s and minus 50s. So it's a specialized fleet for that matter, but important to know that historically, diesel is the fuel incumbent, for remote areas. Diesel has always been the fuel of choice. Now, what we've done over the past 5, almost 6 years, is we've been retooling our fleet to include natural gas fired power generation. And what that allows is, because many of our clients are natural gas producers, there's an opportunity to use their own natural gas that they produce on site or nearby. And that way, it eliminates a charge to a third party fuel distributor that the client would need to, these sites are in very remote areas. A tanker going up the road to deliver thousands of gallons of diesel every day can be eliminated by utilizing their own natural gas. Now, this natural gas in the field.
Let me dive into that, because I want to segue into specifically when in 2022 you unveiled Evolution Power Projects, because this was a very transformative thing for you as a company, as well as for the industry. In years past, and we want to look forward and not too much in the rearview mirror, but you had a lot of different divisions with enterprise that went beyond the energy industry. You had civil engineering and infrastructure projects. One company, remind me which one it was. You sold one of your companies for a really nice profit a few years back.
Yeah, we made two dispositions in 2016 and 18, and they were our infrastructure construction businesses.
Right.
So we had our one company, TSE Infrastructure. They specialized in the installation of underground utilities. So everything from fiber optic to power and natural gas into, basically when they're building residential, commercial, industrial subdivisions, what have you, that organization would go in there and install all of the utilities for that particular development. The other business that we had was a very specialized tunneling business, and it specialized to the point where there's not a lot of competitors in some of those disciplines, and we made an acquisition of a very, very new pipeline tool. It's a tunneling piece of equipment out of Germany. Heron Connect makes that particular piece, and we had acquired that because a lot of the pipelining that was happening and all of the directional drills underneath, sensitive areas, rivers and low-lying wetlands and what have you, required a specific technology, and this was one of those. So, we had this piece of equipment. We were in that downturn, and we felt that we had to make some moves. These two particular dispositions happened, like you said, at very promising valuations for us, and it allowed us, in that very low active period that lasted almost 7 years, it allowed us to go net debt free when we made those dispositions, which gave us the opportunity to position ourselves where we are today with that retooling.
Right, and that's key, folks, because your partner Len, and you have done an incredible job of not only guiding enterprise through a long bear market in energy up in Canada, worse than what we had in the U.S. for a part of that same stretch, but making these sales, getting out of debt. You bought back some shares along the way as well to tighten up your cap table. But the big thing is you're now all in. and retooled when there's now a new upswing in the Canadian energy space. It's not enough yet. It's going to get better. We agreed in our previous conversation, but that's where I want to get really into evolution power, because that was, as you guys emerged from the hunker down mode, that was a big move that you made, and you started to explain as far as diesel is concerned.
Mhm.
Folks, when these guys are operating and they're helping companies that operate in drilling conditions, I can't even picture, I don't want to see 50 degrees, Fahrenheit, let alone 50 below Celsius. That's why I'm in
Yeah.
Florida. For crying out loud, that's crazy. And so, yeah, I mean, it's a lot of wear and tear and stress on equipment. You've got to have the very best. And you guys have done something incredible with Evolution Power. I want to spend a few minutes on that before we get
Mhm.
into your latest acquisition that makes you even more important to your big energy industry client. I'm going to put the slide up on here again. Folks, these are Enterprise's customers. It's all everybody of significance just about in Canada that produces energy. You guys are helping them out. And I have been in remote locations where you've got expensive, smelly diesel that you've got to transport and truck in. That adds to the cost. The diesel fuel adds to the cost. And you guys have now done something that had never been done before for the energy industry in remote places with Evolution Power, with the equipment that you have to use either trucked in or in some cases, you said, a customer's own gas that they can use to
Yeah.
power their facilities. That's tremendous.
Yeah, certainly in the energy sector, where we're supplying mobile natural gas turbine generators to site, over 80% of those sites were actually utilizing the client's own natural gas that's produced on site or nearby. So it's a higher percentage of those sites, and the client can eliminate that fuel cost completely by using its own fuel. I mean, however they want to account for using their own fuel, but I mean they are literally cutting an expense check to a third party diesel distributor to bring that diesel out. Well, that can go away in its entirety by utilizing their own fuel. I mean, some of these clients of ours that you saw up on the screen, it's not a complete list, but those are many, recognizable tier one names that we're working for in the field. But, a company like Tourmaline that we have up here, which is Canada's largest natural gas producer, I mean, their reserves are in the trillions cubic feet, multiple trillions of cubic feet. So what little gas they would use on a project site is, it's what you'd find in a spacesuit, right? It's just not much at all. So it is obviously on the economic side of it. There's tremendous savings to be had by utilizing their own fuel. But further than that, the liquid handling and refilling of multiple diesel generators on site, and physically the handling of liquid diesel, spoke goes in, spoke goes out a little bit on the ground, and so that environmental and that safety issue nearly goes away once we connect the turbine generators to the fuel source. There's no more handling. Where daily there would always be liquid handling of diesel, and of course that tanker going up the road, up the highway, a few hours, and an hour into the wilderness, that's off the road as well. So, but the ultimate is when you move from diesel to combusting natural gas, the emissions reductions are massive. They're not small. They are massive
Right.
reductions in emissions when we go from diesel to natural gas.
Well, and apart from the obvious cost savings, and you guys document that well, how much cheaper it is to burn
Right.
natural gas, whether it's a customer's own or somebody else's. You are also helping them to meet mandates for reducing emissions from their different drilling sites and operating sites.
Mhm. Yeah. So here in Canada, we do have some regulations. It's really focused on what they call the heavy emitters. It's the LETS regulations, which came in a few years back, and basically anybody that is producing more than 1,000 metric tons of CO2 are caught in this regulation. So they would have to track, monitor, and report their emissions. If they're over, they have to buy carbon credits to get them to that threshold. If they're under, they can earn the gap in carbon credits. So in Canada here, we've had a bit of a disruption with the election. They've put things on hold and put them to zero but we know they're not going away. But generally speaking, they started at $70 a ton, then they went to 80. This April 1st, they were supposed to go to $95 a metric ton, and then Carney in the middle of the election sort of stopped all of that for the moment. But eventually, in early 2032 or something, they're supposed to be escalating all the way up to $170 a ton.
Wow.
So the pricing of that, obviously, if you can get if you're a tier one producer, you can get your emissions down well below that, earn $80 and $95, knowing they're going to be a value of eventually $170. You want to make those emissions reductions sooner than later. Obviously, this method that we're employing in the industry is one method that they can reduce certainly on these project sites. Whenever they can displace diesel, this is an opportunity to use nat gas turbines that are out of our fleet, and the reason we've started to build our fleet around around the turbine, and it's specifically the flex turbine, is because of the uptime. The uptime is 99.5+%.
Yeah.
For example, if we use a diesel generator, a reciprocated engine, a piston engine, or a nat gas piston engine, both of those, regardless of the fuel they combust, they both need, just like everybody's vehicle, they need oil changes and filter changes on intervals, 500-600 hours. These types of engines are done. So they need to be stopped. That's downtime. They need to be, and now 500-600 hours is a very, very frequent interval. So you got that downtime and the cost of that maintenance. The flex turbine has one annual 5 to 8 hour service annually. And major workover is at 80, 90,000 hours. Well, there's a little bit over 8,000 hours in a year. So you can appreciate, if you look at 500-600 hour intervals, that's a lot of maintenance across across a year. That's downtime. So when we're on project sites, and because of the uptime, and like I described, our flex fleet operated right through those minus 52 nights and all the way down to it, and past minus 40 and what have you. So that kind of uptime is unheard of in the reciprocated type engine. So right. Project starts. Our projects that we're on are either several weeks to several months. We turn on the generator. At the end of the project, we turn it off.
Yeah, and it goes the whole time.
That type, absolutely.
Yeah, I mean, and you have to have that because you were describing it a little bit earlier, Des. But I mean, you need the power lights. You've got housing that you bring in for some of the crews that stay there. They've got to be. Yeah. You've got medical facilities. You've got offices. You've got bunkhouses. You've got the dining hall. You've got everything, let alone all the equipment and so forth. You can have the downtime. Well, you brought up you brought up the flex turbines because that was your most recent acquisition. Just several weeks ago, was to buy the Canadian assets of a company called Flex Energy Solutions. And so that basically, this is my characterization, I'll let you give your own, that kind of perfected the regimen of these natural gas fired power plants, infrastructures and whatnot that you already had with Evolution. Now you've got something that makes it all work that much more efficient, right?
Yeah, well, you see, I'll explain, give you a little background with Flex. Obviously, when we started moving to the retooling our equipment to nat gas, we in that sort of we're trying out different manufacturers because you're really looking for reliability and uptime. So we were trying some, nat gas, recip, Caterpillar engines, and Cummins, and PSI, and Doosan, and what have you. Even Waukesha. We've got some Waukeshas in the fleet, and when we found the turbine technology, and of course Flex has quite a reputation in the energy sector. So all of those companies that you showed up there, many of them have purchased Flex turbines to be operated as permanent installations in their natural gas gathering systems. So they've gotten a reputation because they're placed in permanent installations in these very, very northerly locations where they're subject to these conditions that I was describing earlier, and of course they have a tremendous uptime reputation. So it's a turbine that's been known in the energy sector with this type of uptime reputation. What we did with that turbine is we were using it in the mobile temporary power opportunity, and we started to get the kind of success that you would expect from that turbine. So we started not fooling around with any other type of equipment. We started building our fleet around the Flex because of everything I've mentioned, and I don't need to repeat this myself, but working under the conditions and the fuel tolerance is necessary because we're utilizing fuel out in the field. It's not always fully refined. So you need something that has very, very good fuel tolerance, which the Flex does. So we started building our fleet up. Now Flex, and we're buying them from Flex USA, which is the OEM out of Colorado. And we're buying more and more. And meanwhile, they have their own Canadian physical location, and they're basically selling and long-term leasing for more permanent installations. And they were kind of, the two management teams were like, well, what's your plans? They were worried, are we going to cross over into the long-term lane? Because were they building a potential competitor? So we got together, and last September, we negotiated an exclusivity arrangement specific to temporary short-term power needs. That way we wouldn't run into each other. They would refer clients that needed short-term opportunities to us. Anybody that was looking for long-term placement of the turbines, we would recommend back and forth. We were marketing to cooperatively and so forth. But during the time of developing that relationship between the two management teams, we've gotten along very well, and other opportunities were discussed, and one of those was acquiring their Canadian business and being essentially, becoming Flex Canada, which doesn't pigeonhole us to just the temporary power. Now we're all of Canada. The previous exclusivity arrangement was confined to Western Canada and short term. So this now, with this acquisition, the exclusivity arrangement now is all of Canada and no restrictions, short term all the way to long term. And of course, we provide because we've acquired the business, we have all of their OEM turbine technicians that are now our staff.
Oh, that's cool.
Now, yeah, so Evolution Power, our division, and Flex Canada over the last 3 years have worked very well together because there was a client relationship. And so everybody knows each other. But now we've acquired them, and now they're part of our group. That way, Flex, they've got a very robust domestic market in the U.S. and a global market as well, and they had an opportunity to allow us, our funding, our enthusiasm for the Canadian market to flourish, because our plans are actually much bigger than Flex's plans that they had for Canada. They were only up here looking to service the energy sector. And of course, our opportunity is energy sector and commercial, industrial, and all industries all across Canada.
Nice.
So it allowed them to take the funds from the disposal. They can ramp up their plans is specific to the U.S., and we're going to work together on these North American two markets together.
Nice.
And so it's transformational for us because it now allows us to operate in expanding to all industry, commercial, industrial, energy, mining, what have you.
You know, it reminds me of a commercial years ago. I think it was Norelco. It might have been Schick, but there's a guy who became the CEO or something like that of one of the big, electric razor companies. And I remember the punchline of the commercial. I like the product so much I bought the company.
Right. I remember those commercials. That's
Yeah,
right.
so that's what you did. So
Yeah.
finally, I mean, you have also with evolution, I mean, essentially a monopoly or nearly that. I mean, there's really nobody else that survived the downturn that's as big a player in that for the, companies in Western Canada that you service, is there?
Uh, you're pretty correct on that. The larger service companies, the Tricans and
Okay.
whether they're the Ensign and the Precision Drilling and the frackers like like I said, Trican and Step Energy up here in Canada. Those are more substantially sized companies. The site infrastructure businesses servicing the energy sector tend to be smaller. Single proprietor, one, maybe two locations. Um, we're one of the few site infrastructure companies that has multiple locations across our sedimentary basin. So we would be, even though we're a micro cap company, we're actually one of the bigger in our little segment of site infrastructure. So when you mention the downturn, well, that 7-year downturn that we described earlier, almost half of the energy services companies, big and small, didn't make it out the other
Right.
end. So as things started to increase in CapEx spending in the field, which happened about midway through 2021, the competitive landscape on the services side had changed a lot. A little less populated, and anybody who made it out the other end, really was in a pretty skinny situation. And if anybody had any debt, the debt holder would be dictating how you would be spending CapEx, or if you had any to spend at all. So we've only had a few good years or better years for any of these people to get themselves back on their feet. So we started our retooling actually before the uptick,
Right.
because of the financial nimbleness we've put ourselves in by those two dispositions. We started this well before. So when the uptick happened, we're positioned at the tip of the spear. We literally at this point doing what we do in this nat gas turbine type of electrification on site. We really don't have any real competitors with us. If anybody would compete with us, they'd have to come up with a $10 to $18 million check just to, and I don't know what they would build their fleet around.
Right.
Right. Because we've tried everything. There's 3 microturbine manufacturers in the world. One of them's out of one of the Scandinavian countries. The unit they make is not gonna be exactly what would work in this setting. The other one is a California made, and we have 6 of those in our fleet because we wanted to try them as well. And they just simply fail at minus 18 and worse. They don't have the fuel tolerance. So, we knew we weren't going to build the fleet around those. So, I mean, I'm not sure what equipment can compete with the kind of uptime we have with the flex unit. Plain
Right.
and simply.
And that's great. That's a great position to be in. So I want to talk a little bit about the more recent, last couple financial statements and the share price performance. A lot of people were a little surprised when they saw the fall off, back in the winter, early spring time frame. And as I said before you came on, a lot of that had to do with just the overall energy sector because of tariff worries and economic worries. And in your case, there's probably some profit taking because hell, you started out from the bottom a few years ago at what, 16, 18 cents a share, went up to nearly $3. And so
Mhm.
probably forgive a few people for taking a little bit of money back off the table. But when you came out with your Q4 and full year 2024 financials, it was a little bit subpar, I think a lot of people.
Mhm.
But you explain that and give us a quick cliff notes. I mean, I already told our subscribers about it, but give us your
Mhm.
take on why that is. And of course, since then, about a month or so ago, you came out with your first quarter numbers already and already rebounded a fair bit as far as your operating numbers.
Yeah.
So tell us why you had that little bit of a hiccup and then maybe look forward to the balance of this year.
Yeah, for sure. So, if you look at 2024, certainly, and you can look at our quarterly, uh, financials through that year. 2024 started very, very robustly. We had a rocket fueled Q1,
Yeah.
and it led into Q2, which is usually our spring breakup quarter. So, because of going from a hard frozen ground to thawing out, where in the remote areas it gets soft enough where the ground, you just can't move around heavy equipment. So certain areas you just can't move around. So Q2 in our service industry is always a weaker quarter. Having said that, it was a rocket fueled first front half, right? Q1 and Q2.
Right.
Q3, usually you come out of the soft Q2 and you start to build again. And of course, the frozen months are the best for services because once the ground is frozen, it's a competent ground. You can do anything. You can set up and mobilize on that competent ground. But so what happened was we started seeing a number of projects by certain clients of ours get kicked further down the calendar. What we know today that we didn't know then because we're just not privy to it is that LNG Canada was being delayed. If we spin back the tape a year ago, it was Q1 of 25 when they were expecting first cargo out of LNG Canada, and then it was delayed to Q2, and then what we know now is first cargo is the ship actually shows up on the 29th of June.
Right.
So in the first part of July, the first cargo will be traveling across to Asia. So that's Q3. What we didn't know, because the players that are involved in feedstock for that LNG pipeline facility is they knew there were some delays and they kicked those projects down. So things that we had as word of, basically we had word that certain projects were going to start, late Q3 into Q4, got kicked into the calendar further. So our softness of specifically that Q4, caught us and everybody else by surprise.
Gotcha.
And we had what it amounted to is a rocket fueled front half of the year and a softer back end of the year. Now, what we're seeing this year is our Q1 this year was by any stretch, it was a very good quarter.
Good.
It didn't meet the revenue that we did the year before, but all the profitability and the margins were, if you look at that as a standalone quarter, it's great margins. We made good. If you can just keep repeating that, life is good.
Yeah.
But what's happening is because of this, now we have LNG Canada, which is going to take away a little bit over 10% in its first phase of Canada's gas production. This is going to move the needle here. And, now we've got flow, then momentum and inertia from the flow and the takeaway is going to be in place now. This is now there should be a steady diet of activity now.
Right.
Okay, so we expect the second half of this year to be much better in the way of activity than we saw the back half of last year and the front half of this year. So I think the treadmill starts. Good. Is what we're expecting. Okay, good. And so that's how we see it. Now, further than that, we have 3 other LNG projects in either different stages of construction or permitting that we see will be successful, working LNG plants inside of the next 2 to 3 years. So first is wood fiber. It's being constructed. They're looking at 2028 as first cargo, and that's over in the Squamish area. By the way, the three that I'm going to name all have First Nations ownership and involvement. So wood fiber with the Squamish First Nation, and then you have Cedar and LNG, which is the Haisla First Nations. And then the Kasi Lasims, which is the Niska First Nations, also paired with Pembina pipelines. So you've got the proper midstreamers and like partnered, and these aren't as big as LNG Canada in daily production, but in aggregate, we're going to have a third of Canada's production going off when all these are operating. Well, that's an absolute needle mover.
Oh, sure.
For Canada and our Canadian gas producers. So if you look at all of the LNG that's going to be liquefied here now, starting now and into the future, that, like I said, that treadmill starts going, and the production needs to keep pace. And of course, we've got tremendous resources here in Western Canada. So we think we're positioned correctly for this next phase of Canada's involvement in LNG globally.
Well, if they're doing well and they're producing more gas for export and all of the things that go along with it, they need you. And
Correct.
there's that much more of your services and equipment that they need. And so, yeah, I mean, it's the future probably hasn't been this bright for you guys up there in a long time.
Yeah, I'd agree. I mean, we did go through that 7-year period.
Right.
It was a 7-year period of low activity.
Mhm.
And not only that, because of commodity prices, our clients, they come to the services like us and they say, listen, this is how it's going to be. If we're going to work in the field, we got to do this together. The commodity prices aren't there to substantiate increased activity. So we're just, what it's like for producers. If they don't drill, their decline rates go in. So they got to drill a little bit even to keep a flat line of production. So there at least is some activity. But if you're going to be involved, we need discounts. And we did. We were there because we've learned that if you lose a client, the cost to get a client back, or even at all, you can't lose clients. So you got to sort of hold hands together and jump off the cliff together and hope you land okay, right? And we said the answer to clients can never be no, unless it's terminal. But you got to partner up. And hope that sort of goodwill that you may generate over those bad times translates through the good times. And more so than not, it does.
Yeah, and you've been able more than once in the recent past to start bumping your prices back up to cover your costs and to make more of a
Yeah.
profit. And that's come through, and it's great that now when everybody had to share in a sacrifice before, now everybody's starting to share again in the benefit. And with these other export projects coming on, and the overall need for ever more energy everywhere, you're really, really, really in a great place. And my congratulations again, as I do from time to time, to you and Len both for sticking out the bad times, and now you're going to prosper, and shareholders are prospering. So I thank you for that especially. So
Yeah.
yeah,
I appreciate your recognition over the time. I mean, I think you and I met when what was it, in the sort of 2009 to 2013 range, somewhere in there.
in there,
It was building up from a low period.
right?
And then, of course, the floor came out in
Again.
late 2014 and 15. We still continued to have our phone calls and talk about the industry, talk about the political situation and the regulations and all the net zero insanity that we've had to endure and do. But where we are today, considering the how long we've known and stayed in contact with each other, yeah, we've seen some certain ups and downs.
Yeah, and now back to the ups again, and that's been very, very nice to see. And folks, I can't stress enough, and I said this a little bit ago, that looking at where enterprise business is today, their share price and so forth, but the greater landscape ahead, I think, for energy, and especially in Canada. It's every bit as compelling to take a look at this story now as it was when we were at the bottom and nobody wanted anything to do with Canadian energy. You've still got a lot of runway here. And so I encourage you again, as I did at the outset, get in touch with the company, get on their mailing list, contact them. You know, sometimes you answer emails personally, Des, from time to time. So that
Yeah, I
contact the
do.
enterprise group, they'll visit with you, get on their mailing list. And again, keep in touch with yours truly. We're going to have some follow-on information even after these twin videos, this one and the other one Des and I did that's out in conjunction with it on the broader landscape of Canadian energy, public policy up there. A lot of work to be done still, no question about it, for your industry up there, just like there is for us here in the U.S. But in a world that has an insatiable appetite for ever more energy, we're both in great shape. Both countries are in great positions. You guys especially, because your energy industry is not as far along as a lot of stuff here in the U.S. You've got a lot of opportunity to monetize for your country, for the province, and for your shareholders. This wonderful resource you have, and you don't hear, and I love what you said about Tourmaline. When you've got a company with that kind of low-hanging fruit in the trillions of cubic feet, it's a lot of business and a lot of money in the years ahead. So, Des,
Yeah.
congratulations. Have a great summer. You and I will stay in touch, of course, from time to time, and I'll look forward to our next formal visit together.
And so do I. Thank you, Chris.
Take care.
For much more of the National Investor's cutting-edge content and actionable investment opportunities, make sure to subscribe to Chris's free content at nationalinvestor.com. And don't forget to like this video and subscribe to this channel too. Thanks for tuning in, and we'll see you next time.